Canada's pre-construction housing market has gotten so bad that even governments are suffering. The pre-construction market has slumped dramatically since the pandemic boom. In the Greater Toronto Area, Canada's largest market, pre-construction condo sales hit record highs in 2021 with over 30,000 units sold, but have completely plummeted since. Only 12,000 new condos sold in 2023, down 58% from 2021. And that made 2023 the slowest year since 2008. And 2025 is expected to smash that record with the lowest pre-construction sales since Canada's last housing correction or last major housing cycle, which was the 1990s. By 2023, developers struggled to sell even half of the units that they were launching, compared to an 82% absorption just 2 years prior in 2021. And this downturn worsened in 24-25. By the third quarter of this year, the GTA new condo market has been on track for its worst year in 35 years, with quarterly sales now down 92% below the 10-year average. That's not just 92% below 2021, which was a high peak. That's 92% below the 10-year average. And this means that we've seen a huge rise in project cancellations. 4,000 condo units were canceled in the first 9 months of 2025 alone, which is already a record high. And other regions across Canada are seeing similar trends. In Vancouver and other major cities, developers are reporting record low sales of new units, forcing many planned projects to be delayed or shelved. In short, the construction pipeline in the GTA is slowing to a crawl due to the pre-construction condo sales slump. Outside of Ontario, you're seeing a lot of projects get completed due to CMHC's MLI Select financing, which is for rental housing. About 88% of all apartment starts right now are financed by CMHC or insured by CMHC. But deals with this type of financing simply don't work in the GTA and surrounding areas. And one of the big reasons for that is because these municipalities charge such a high dollar value for development charges. It completely breaks the economics of development for. Now, development charges are a big piece of revenue for these municipalities. This move would actually cost the city of Burlington up to $75 million. But the reality is that $75 million that they probably never would have collected, or at least they probably wouldn't have collected within that 2-year period, because developers can't afford to build a unit. If the DCs are gone, then developers can afford to reduce their prices a little bit, which makes it a little bit more likely that they're going to sell these units, or that those units can work as purpose-built rental projects financed or insured through CMHC MLI Select financing. But development charges aren't the only type of revenue that municipalities collect, right? They have CapEx, which is financed through development charges. So development charges, or DCs, pay for capital expenditures. So this is an investment in assets, basically like funding the growth of your municipality. So water, sewers, roads, parks, parkland allocation, those things are paid for through development charges. But your operating expenditures, or OPEX, your operating expenditures are ongoing expenses like running the municipality. So this is things like repairs on the roads, or paying the salaries of people who work for the city. And operating costs and the operating budget is typically financed or paid for from operating revenue. And operating revenue typically comes from property taxes. Now, if Burlington was able to reduce development charges and get more housing units built, not only would they get that capital expenditure revenue, or revenue that could go into the CapEx budget, but they would also get the property tax revenue from all of those new units that are being created. And if you want to estimate the value of that, you could basically take the assuming that $75 million that they are saying is a cost that they would no longer get from revenue. Typically that $75 million represents about a quarter of the value of a new home. So you could just take the 75 million and multiply it by 4, and that would get you sort of the total market value or assessed value of those units that would be coming on the market. And then you would just take Burlington's property tax rate, or mill rate, which is the rate that they apply on the assessed value of the properties. And if I put in that $300 million worth of development that would have taken place over this 2-year period, if they're estimating that $75,000 loss at their mill rate of just below 1%, or 0.91% according to realist.ca, that is a annual property tax revenue potential of $2.75 million that they're also getting rid of. And that's in perpetuity, they'd be getting a minimum of $2.75 million from the creation of these units. That's their annual recurring revenue that they get from allowing these units to exist beyond the development charges that they get. Burlington's not alone in this, by the way. In Toronto, approximately $138,000 per single detached unit is what the city charges for creation of new housing through development charges. And for comparison, Toronto's DC was under 15,000 in 2010, meaning that they saw a 900% increase between 2010 and present day. In Oakville, that number is around $150,000 per house. In Burlington, it's about $115,000 per house. In Hamilton, it's about $80,000 per single detached home after a recent 20% cut. And remember, we have seen multiple municipalities actually start reducing development charges in response to this huge issue that we're seeing forming right now. We've seen Mississauga cut their development charges substantially. Vaughan cut their development charges, although they had just increased them by like 80% the year prior. Even in cities like Vancouver, you're at about $436 per square meter, or about $40 a square foot for high density residential projects. So lower than what we're seeing in Ontario. And this is why you're seeing a lot more purpose-built rental housing get created in markets like British Columbia, even though the land cost structure and market structure is very similar. It's equally inflated compared to Toronto. In a city like Calgary, about 22,000 per new housing unit on average, which again makes development in all of these markets far more compelling than in the GTA. And so it's clear that Ontario cities have some of the highest development charges in the country. A recent study actually found that in the GTA's 10 largest municipalities, DCs for a single detached home averaged $113,000, roughly 25% of a home's affordable price threshold. Whereas in 10 large municipalities outside of the GTA, the average development charge is about $52,000, around 13% of a typical house price. And these fees have become a major factor in project costs and therefore home prices that get passed down to the end consumer who ends up buying the unit from the builder. Even if that's an investor, it gets passed on to the tenant through rent. And the sharp decline in new development is hitting cities hard financially. Municipalities rely on development charges to fund growth-related infrastructure. So when housing construction falls, DC revenues fall off a cliff. An Altus report noted this dynamic during the 08-09 recession, and in a report that stated that as the volume of new housing construction declines, municipalities are finding their development charge revenue is falling dramatically. And today's housing slowdown is creating the same challenge, except far worse based on the data I presented earlier in this video, given that the 08-09 downturn is more comparable to what we saw happen in 2023, and the 2025 number that we're seeing is so bad that you have to go back to the 1990s when our population was 10 or 20% smaller to find a year where fewer condos sold. And the problem is that many city budgets had counted on this steady stream of development charges that is now drying up. For example, the city of Toronto expected over $700 million in development charge collections in 2023, but much of that is at risk if new projects don't get to proceed. And this shortfall forces cities to delay infrastructure projects or find money elsewhere. And we know where this elsewhere is likely to be. It's likely to be from taxpayers at the federal level, given that the federal government is basically now coming out and saying that details on housing development charges can be expected in the federal budget, according to Housing Minister Gregor Robertson. And so we only have to wait a couple of weeks into November to understand the fate. But given the information that I've outlined for you already in this video, the challenge with this approach is that if they pay municipalities or pay a portion, I've heard numbers like 50% thrown around. If the federal government pays 50% of development charges, you're almost rewarding cities that have high development charges for doing so by comparison to cities like Calgary or Vancouver, who have much lower development charges. And this has been encouraging housing in a free market fashion. Housing has been getting created in a very efficient way, where you're seeing way more construction taking place outside of Ontario than in the GTA. And paradoxically, some municipalities have actually accumulated large development charge reserve funds from the past decade's building boom, and they have a bunch of cash, like billions of dollars sitting there that they can't efficiently spend. And they've committed billions more to spending, like they've already spent it or committed to spending that money, but they haven't actually allocated the capital. The project haven't actually been undertaken. And they also face anemic incoming fees. Ontario municipalities collectively have over 10 billion sitting in DC reserve accounts, which is up 278% from 2009. And these reserves ballooned because development charges and revenues grew faster than cities could spend it on projects. So they were taking in a bunch of money on the promise that growth was paying for growth, or that all of this money would be spent to improve the areas where all of this housing was being created, or to grow the municipalities, to grow the infrastructure base, to make housing more achievable. But they grew their revenue faster than they could spend it on projects. And so the problem is we've got a whole bunch of municipal governments that are now underfunded as a result of contraction in a bunch of programs, interest costs going up substantially. And these funds are earmarked for long-term needs and can't easily be repurposed to fill budget gaps on the OPEX side, on the operating side, because they're committed for capital expenditures. So a lot of people think like, oh, they made so much money off development charges, how can they be running a deficit? Well, they're two completely separate budgets. Similar, I put up a graphic earlier about CapEx and OPEX, and it's the same way that accountants would allocate the capital in those two things. OPEX especially is fully tax deductible, whereas CapEx, because you're investing in assets, you actually have to end up depreciating it. And you'll often hear Carney talk about how, while they're spending a ton of money at the federal level, he is planning to allocate that money towards CapEx rather than OPEX, because they're trimming jobs, they're reducing the operating line, and they're hoping to invest it in growth they're building. And this is what municipalities were supposed to do with the DC revenue. And the reason that I mentioned the federal level and Carney and his language around this is because it wouldn't surprise me to see, it's just such a direct example of the difference between CapEx and OPEX at a government level. Minister Robertson is already saying that the federal government plans to do something about development charges. It sounds like they're just teeing it up for a federal subsidy towards development charges, which my fear here is that this kind of rewards bad behavior, where the municipalities in the city, or in the greater Toronto area, are getting rewarded for keeping development charges high because the Fed now is going to hop in and just pay half of them. There's no incentive for them to actually reduce those charges better, allocate capital better. And so in the meantime, the current housing slump will mean far fewer new charges getting paid to these municipal governments. And municipal leaders worry about revenue, but developers point out that when construction is halted, if you waive development charges, the cost is actually minimal. Why? Because nobody's building. So 0 times 0 is 0. Municipal governments can continue collecting no development charge revenue and no property tax revenue from the units that would have been built. Or they can decide to make a change to their structure on a short-term or a long-term basis to encourage development and actually keep Canada's housing economy moving. In other words, cutting or freezing development charges now might not cost cities much in immediate revenue, since very little would have been collected anyways. Like Burlington, using that $75 million example, is operating on the assumption that $300 million worth of real estate developments would have taken place over the next 2 years, which just isn't realistic at all, because at current prices with current development charges, there's no way they would have collected $75 million in development charges. And so this is why you're seeing cities reconsidering the development fees to stimulate building. Hamilton approved a 20% citywide reduction, DC reduction, for 2 years until August 2027, lowering the charge on a single home from $98,000 to $79,000. And now cities like Burlington are contemplating going even further with a 2-year pause on development charges to aid their struggling housing industry. And their council launched a review in late 2024 to analyze temporarily reducing or eliminating, given what their mayor called the sharpest downturn since the 1990s. And the idea is that a short-term development charge holiday could encourage developers to proceed with projects that are on the edge and might push them into affordability, either as a rental or a condo where they can get the prices low enough that the market might actually absorb them. We saw this happen in Mississauga, Green Park site, where they had launched previous phases at $1,400 a foot. They just released a new phase at $875 a foot. So it's like a 40% drop in the price that they're able to bring that unit to market at. And a lot of this is because Mississauga reduced their development charges by 50%. And they actually did it to 100%. So no development charges on family size units. So 3-bedroom properties in purpose-built rental apartments. Vaughan reset their DC rates to 2018 levels, effectively cutting low-rise charges almost in half. And these measures reflect a new willingness to sacrifice fee revenue in order to keep development moving. And the part that interests me the most about this is that this is deflationary on house prices. Like, this takes your new housing costs and reduces the price of it, which puts more downward pressure on the resale market, on the entire housing market from the top, because the top is sort of where so before your resale market sort of sat here and your pre-con market actually sat above that. And now if your pre-con's coming down closer, then it gives your resale market more room to drop. And it's also almost created an environment in which municipal governments are competing for who can create the most compelling tax structure or development charge structure, cost structure for developers. If this continues, then you'll have the entire GTA municipality competing for that investor or first-time home buyer capital. And this really is the way that you're seeing it, right? You're getting these suburban markets around the city of Toronto competing for a lot of that capital, the very limited buyer capital. There's so few buyers right now, the very limited buyer capital that is still in the market. They're competing for it by reducing their cost structure. Vaughan, I would say like a 905 pre-con condo is pretty interchangeable. You've got Pickering, like your 905 condos that are within the first ring of Toronto. You've got your Vaughan to the north, Mississauga to the west, and Pickering to the east. And they all kind of launch projects in similar ways around shopping malls, tall tower. Pricing is pretty comparable. And so whichever municipality can reduce development charges and allow developers to drop those prices the furthest is going to get the most sales, which means they're going to get the most development, the most jobs created in their municipality, the most future tax revenue in their municipality, new residents moving to their municipality who are now going and buying at local shops. The economic growth that comes as a result of being a leader in this policy and the winner in this race to the bottom that we're seeing happening is actually substantial. And you're already seeing that taking place with this competition forming between your sort of first ring suburbs and the 905. And so even though cities need to fund infrastructure, the high fees are now seen as a huge part of this problem, and they're hindering new housing. And the question is, do we want to deal with an infrastructure problem that we kind of already have and people have seemed to tolerate for a long time? It's not like the GTA is super well known for having exceptionally good infrastructure. Or do we want to continue dealing with this absolutely severe housing crisis? And so, as I mentioned in a recent video about how the government is going to systematically reduce housing costs, and Canada's federal government has also recognized development fees as a barrier to housing and has floated relief measures. Gregor Robertson, the former Vancouver mayor and now federal housing minister, highlighted the impact of ever-increasing municipal development charges on housing costs. Robertson reiterated this pledge in October 2025, noting that development charges are a significant challenge for the cost of building across Canada, and this is why they've made a commitment to reducing those charges. And they indicated a goal of a 50% reduction in partnership with the provinces and territories, potentially via rebates or incentive funding. Obviously, details are going to emerge in the federal budget, which comes out soon. However, he did stop short of confirming immediate action, instead pointing to ongoing negotiations and again hinting that these details would come out in the federal budget. His cautious tone led some observers to question the government's commitment, but their office later affirmed that the 50% cut promise remains on the table. The reason the federal government is eyeing development charge reduction specifically is to improve project viability and accelerate home building. It's what we need to see in this country if we're going to solve the housing crisis. Industry groups have long argued that these hefty municipal fees simply get passed on to homebuyers and make projects infeasible. The Ontario Real Estate Association, for example, found that development charges add on average $135,000 to the price of a new home. And they even claim that some cities use these fees for general revenue beyond the strict growth cost that they're supposed to be allocated for. And so cutting fees would therefore lower prices or at least make marginal projects worth pursuing again and potentially bring more stock in that's viable as rental. All of this putting downward pressure on rents and downward pressure on house prices. Now, of course, any federal intervention likely requires compensating municipalities for lost funds, but the political will to reduce development charges appears to be growing. By late 2025, even Canada's National Housing Agency, CMHC, was calling for ways to mitigate cost volatility from municipal fees to ensure that housing supply gets built. All levels of government seem to agree that in a housing affordability crisis like the one we have, the usual growth pays for growth funding model for municipalities needs a rethink. In the past, the federal and municipal governments used to actually fund, pay for, and build these infrastructure projects on their own, and those costs were actually downloaded to municipal governments. In Ontario, I believe in Ontario, it was done by Mike Harris and Ernie Eves, and that was partly reversed after their tenure by a couple of years of Liberal governments. After that, I think you had McGuinty and Kathleen Wynne. But the challenge is that your municipal budget cycles are much more volatile. They're smaller. Your elections are different, and they don't survive some of these long-term capital projects that are required to make huge housing and infrastructure commitments. So the coming months will show whether Ottawa and the provinces actually can step up with concrete programs to lighten the load of development fees. I've heard rumblings that there's going to be changes at a provincial level from the province of Ontario as well. And honestly, we have seen numerous examples of Ford's government actually trying to front run the Fed and take action. I think the bigger question is whether or not these changes are enough to reignite home construction during the ongoing housing market correction that we're seeing in Canada. Will we end up with a similar housing boom, especially in the rental supply side of things, where basically everywhere outside of the province of Ontario, we're seeing almost record rental under construction, but in the province of Ontario, we're seeing a huge drop in the number of apartments under construction, and especially in the GTA and GTHA, we're seeing very few viable projects from a rental perspective. If development charges go away, could this change? Yes. Could it make more rental projects come online? Yes. Could it make more condo projects come online at prices that buyers can actually absorb? Yes. What is the ultimate outcome of that if that happens? Rents fall, prices fall, we see more supply, the market trends further in favor of buyers, further out of favor for sellers, and we end up in a long-term balanced supply or even buyer's market. It's a great thing for housing affordability. It is not an exceptionally good thing for people who are bullish on house prices.